And we're live.
Good morning and good afternoon, everyone, and welcome to SRP's latest virtual live panel, which today will be focusing on how to grow the Untitled Chapter. It's a very timely topic, given that total annuity sales in the US reached their highest recorded figure in 2019, since hitting a peak in 2008. Much of the overall growth can be attributed to the continued rise in the fixed indexed annuity market, whose sales increased in 11 of the past 12 years. I think no discussion now would be complete without mentioning the wider macro environment, which is also having a huge impact on this space, and is highlighting how crucial annuities can be as part of a portfolio as one source of guaranteed income. Which means that today our panelists have a lot to go through. I would like to start by introducing our moderator today, Tamiko Toland, Head of Annuity Research at Canex Financial. So welcome, Tamiko, and thank you so much for taking the time to be with us today. Tamiko will be joined by 4 panelists who span the entire annuity spectrum. Tim Bonacci, President and CEO of Luma, Charlie Gipple, Founder and CEO of CG Financial Group, Danette Kennedy, Independent Strategist and Annuity Consultant, and Vinit Srivastava, Co-Founder and CEO of Mercube. For everyone listening, thank you very much as well for taking the time to be with us. Just to let you know, you've got the ability to ask our speakers some questions on the bottom right-hand corner. There's a little Q&A arrow that you can type the question in. And so guys, thank you very much for lending your expertise to us for this webinar today. Over to you, and over to you, Tamiko, first. Thank you.
Thank you so much. Welcome, everybody. Thanks for taking some time out of your day for this webinar. I know there's a lot going on right now, and we all have to be thoughtful about how we spend our time. At the same time, this is a unique moment in history, and we are facing unprecedented uncertainty, coupled with the tremendous opportunity offered by annuity products given the situation with retirement. So, it's unprecedented in so many ways. So I just give a little bit of background on myself. So I'm head of annuity research at Canex. We provide data and analytics across all types of annuities in the U.S. Many folks know us for income annuities, but we do actually, we're quite involved with fixed index annuities, pricing and valuation for the guaranteed income from benefits. Today's discussion is going to focus exclusively on this type of index-linked product. And all of them guarantee policyholders who stay the course are never going to lose principal, and that they can guarantee income either through a benefit or through annuitization. This is really important to level set, because these value propositions are critical to the framing of today's discussion. So the panel is going to be fantastic. Really looking forward to this. These folks are making it very easy for me. I came to research and consulting by way of the trade press, and I originally started reporting on annuities around the time of the tech wreck. So I've seen a bunch of different major market disruptions, and it's really been a great vantage point for observing the change in products and practices and trying to understand the future. So, having seen the industry adapt through prior events, I think that's given me personally a lot of confidence about the stability of insurance companies, and that moving through this period of time, we're going to end up, I think in a really strong position to be able to serve policyholders both with products that had been sold prior to what's called COVID crisis, and ones that we will be selling during and after. So, as I mentioned, it's a pivotal time for annuities, with or without the pandemic and a financial crisis. And, the industry and lots of wonks out there have really beaten the drum about the importance of guaranteed income, particularly in the light of sequence of returns risk, which obviously we're experiencing very viscerally right now. So these times really only underscore the importance of financial planning and they potentially serve to increase demand in the future. So even more Americans are going to need to make the best use of their savings to create reliable income in retirement, especially if they've suffered losses during this time. As I mentioned, it's a great panel. We're really, talking to folks who represent different pieces of the industry and the product life cycle from soup to nuts. There's going to be some great opportunity for questions as well. So I do invite you to use the, I'm not sure if it's a chat function or Q&A here, but please ask questions to Q&A on WebEx. And if we don't have time to get to it, everybody's on LinkedIn, so don't hesitate to reach out, either LinkedIn or the Googleverse. So I'm going to start by asking a single focus question to each of the panelists, and I'll let them introduce themselves and give a little bit of context of what brings them here today. So we're going to kind of start from, the beginning of the life cycle of the product. So I would like to ask Vineet some questions. He's got great experience as far as the actual index management itself. So Vineet, can you share your view on the use of non-traditional indices and annuities and how a new market downturn may shape the industry moving forward?
Sure. Thanks, Tomeko, and thanks, SRP, for having me on this panel. So I'll start with giving you my background and sort of jump into the question, which is, in some ways, actually captures what has happened in this industry. So I'm the CEO and co-founder of Mercube, and we started about 8 months ago, essentially building out an indexing platform, full-service indexing platform, where we are designing, developing, and disseminating indices. Focus is a lot on index-linked annuities, indices for that market. And prior to Mercube, I was with S&P Dow Jones Indices, leading their complex strategies, if you will. So everything outside of their market cap weighted products for 9 years. And as part of that, one of the areas that I focused a lot on was multi-asset indices that are designed for the index-linked annuity space. So it's useful to look at how these indices have evolved, and that kind of gives us a sense of why they're relevant in this market environment today. So if we go back to the early part of the decade, the market cap weighted indices were primarily dominating in this space. Almost 90% of the issuance was linked to 100, the MSCI, FTSE Russell, and such. And after the crisis, as rates came to rock bottom, multi-asset indices and vol control indices became quite popular. And the reason for that was, in some ways obvious to the product designers and the index designers, because it allowed you to essentially participate higher into the returns at a lesser volatility. So when you combine asset classes, you get a lower realized volatility, and then you apply some kind of a vol targeting mechanism, and that allows you to efficiently price some of these index-linked products. So that was kind of the reason why it sort of exploded. And what we've seen is over the last 7-8 years, we've gone from simple vol targeting strategies to more and more complex structures, and structures which embed not only new asset classes, but they also embed outcomes into the index, right? So you're seeing quite an evolution in this space. Now, going back to what's relevant today, it is quite instructive to see that, in a market situation like this, the demand for these products would actually go higher, especially those linked to these, what we can call complex strategy and multi-asset products, because they're facing the same kind of environment with respect to rates. So pricing of these index-linked annuities will definitely get tighter as rates compress. And that gives, a chance for some of these more multi-asset products to come in. And why would these products be relevant today? Some of my panelists will actually go into that as well. Is when you look at how these products are being used, what is sort of the comparison that you're putting it up against. You're more traditionally looking at it against fixed income. You have a principal protected structure. You're getting your money back. So for generating income, the income that will come from participating in upside equities will definitely be more attractive than what you would get from traditional fixed income. So I definitely see, FIA products being very relevant today and going forward in this market. And to that end, I think, the more multi-asset products will have more relevance because of the rate environment, which we have, no idea how it's going to evolve, but, given the economic outlook, it's likely going to be a low rate environment for some time. Those complex or strategy-related products or indices will definitely have a bigger role in the products that we see coming out. So that's kind of a long intro, but I hope I covered some of the items in that.
That's great. Thank you so much. So I want to circle around to Danette. And I want to ask you, how do you think products are going to evolve in the coming months?
Sure. Good morning. Thanks to everyone for joining, as well as SRP for hosting. Tomiko, I think your question is really relevant. And, we as panelists met before and visited a little bit about this. And we've been talking in the industry as well. Most of us on the panel have all been around and seen different evolutions. But I think when you look at the industry and the evolution of fixed indexed annuities, you can really categorize what drives the changes in the product and what drives kind of the evolution of the product. And I think about it in really three different categories. I think the three most significant things that drive evolution of these products will continue to be in these same categories, although with the nuance of the changes we are going through, I think obviously they will push them one direction or the other. But those three categories to me come down to the regulation. The next would be pricing, the volatility in pricing. And then the next category I call kind of consumer demand / competition. So those three, regulation, second, pricing volatility, and third, this consumer demand / competition. I think those three factors have really driven historically what has happened to the product. And I, again, think they will continue to drive it. To speak a little bit more specifically, kind of in 2020 and where we find ourselves today, which is an incredibly unique situation. Again, even though all of us have been through so many of the other market changes, regulation, if you start there, I would not be surprised if we see in the next 12, 18, 24 months a resurgence of this view of the illustration model. The NAIC created an illustration model, and some of the panelists have even more background in IUL. And you can look at Index Universal Life illustrations and how they have evolved. And really from an annuity standpoint, oftentimes you can see the parallels, but the annuity standards are just a little bit time-wise behind the IULs. So I wouldn't be surprised if the NAIC revisits the model. You've already got regulators, especially Iowa, which is extremely active in the NAIC and has always played a pivotal role in regulation, and mostly because you've got so many domiciled carriers for FIAs in the state of Iowa. So the regulators have always been very active and very interested in what happens with these products. But I would expect there to be a resurgence in looking at this. The regulators, some of them, including Iowa, have already said, we're interpreting the rule differently. And they're going to continue to look at the index evolution. I love Vinit's comments related to, complexity and how do you get more complex, but regulators are always going to push as a consumer advocate to make sure that the FIAs are understandable and that the formulas and the calculations don't get so confusing to the consumer. And we all know from the sales side, agents and producers, reps, they like a more simple story. So again, that first factor, I think, for us will be to watch regulation, see how it evolves. And I know, just to touch on it, the best interest standard has evolved as well. But again, the SEC has still said that it may come back and revisit this. It'll be interesting if there's what happens in the elections and if that really gains any traction, but that would be a secondary type consideration. Moving next to what I think is a second significant factor is the pricing volatility. In 2019, we had this rate compression, and you've had carriers throughout 19 reevaluating their pricing and how can we make this work, and what, as a result of lower interest rates and as a result of the Treasury and these inverse curves that we've had, they've already been examining. And this happened in 2019, long before we had the coronavirus pandemic. So this will continue to push the evolution. I think you will see carriers looking at all of the levers that they have in products. They have compensation. They have, whether you've got a bonus, they have all of the levers that are specific to the index formula, the crediting strategy. And so again, it will be very significant for all of them to look at what can we make work. And you'll continue to see carriers that will pull products. They will pull riders. They will not just adjust what they have in an existing product, but they will end up being in a position where they can't make that product work any longer, and they'll just take it off the market and pull it from the shelf, which again is nothing new, happens all the time, product evolution. Carriers are constantly recycling products and removing them, changing them, possibly refiling them. But I do think we'll continue to see that. The last area is what I call this consumer demand / competition. Consumers are, and especially the individuals that sell the products, and I would include the reps, as well as the marketers from the IMO side that are pushing the products and really trying to get people to understand the products. They're very vocal and will continue to be very vocal about what is working. This will continue to be a driving factor. I would not be surprised, in visiting a little bit with some of my colleagues about where we think things are going to go. I do think that an impact or a result of the COVID-19 issues that we are seeing, I do expect, and the market declines, this uncertainty, and really it's not just financial uncertainty, it's uncertainty, can I go to the grocery store? And none of us are immune to all of these changes that are happening. And I think all of that uncertainty is going to drive, from a consumer perspective, a need for more control and a need for more guarantees. And so I think as products evolve, you will see, or I guess I wouldn't be surprised to see, if those features become more significant and become more highlighted as part of the attractiveness of an FIA going forward. And again, it's really a result. These products have always been safe. These products have always represented an aspect of your financial portfolio related to safety and security. But again, even within the product features themselves, I think you will see more of that becoming highlighted and more of those features related to control, guarantees, those type of features becoming even more prevalent.
Thank you so much for that perspective. And I just want to add that I neglected to ask you to give your background, which you really need to do because you have a fantastic, very diverse background that I want you to share with our audience.
Oh, thank you. Sure. I kind of skipped over me and just to the more exciting part, frankly. So sure, a little bit about me. I've been in the industry for several years. I'm actually an attorney, and I started in the industry practicing law, and I'm working in the legal and compliance field for a lot of these carriers. And then I switched over to the sales side because to transition from the attorney work to the sales side is much more interesting from my perspective. And so I spent a lot of time on the sales side, working with IMOs, working with marketers, ran training, and actually ran my own IMO for a period of time. So have lots of passion about the field and how these products are represented in the field, and really getting the message out for really everyone to see where this product fits, if this product fits in their portfolio. So that's kind of where my perspective comes from, I should say. Thanks, Tamako.
Oh, no, thank you so much. It helps give a little bit more color to your comments, because you have such great experience. So I want to move on to Tim. Now, Tim, don't forget to give us your bio and background. But here's your question, which is, what do you say to people who fear that platforms like yours risk commoditizing annuities?
Great. I like questions like that as well. But thanks, everyone, and thank you to SRP for putting this together. There really is a confluence of products, I think, in the marketplace today, structured products, annuities, other products in general. So I'll touch briefly on my background because it may provide some insight. I'm not just a strict technology guy. I really come from the business side, the industry side, and then how that varies in with technology. I grew up mostly in the industry on the wealth management side. But back in 2005, after being in the wealth management industry for a while, for quite a number of years, started a firm called Navian Capital, where we built and distributed structured products across the country, built them for regional banks, distributed them from the large investment banks, and then also expanded then into the annuity side. When vol-controlled indices started getting popular, we were doing a lot of the structured products with those indices. They then migrated in, and Vineet, a lot of things you do are related to that. So we started working and distributing the annuities. We actually built a couple annuities with a couple large carriers and distributed them. But along that way, we had built an internal technology, and fintech is finally kind of hitting the structured product and the annuity side pretty rapidly. So we spun that out. I spend my time solely on Luma now. I'm the CEO of Luma and founded that. And we've significantly expanded the capabilities of the platform. But what we're really trying to do and where we're focused is that advisor buy-side focused platform. We have a couple very large clients. We have clients across the country and a couple very large private banks. We're seeing a fairly significant percentage of the flow from a structured product standpoint, and this is clearly coming down the path on the annuity side as well. These things are getting together. Real quickly, I'll answer your question, but I'll do it in a little bit of an interesting way. I think when you step back and look at fintech, I would say fintech does two things, or one of two things, at a very, very high level. It either makes things more efficient or it increases sales. And I think on platforms like this for annuities and structured products, it can do both. We all know our goal is to increase adoption and ease of use of these product sets. I think we can all be honest that this product, index annuities and so forth, we trade billions of dollars on spreadsheets and emails and Bloomberg chats and in some cases check an app, right? So it has been a very manual process, and the products are getting more complex as well. The most common question I get from advisors or the firms they work for are, geez, which index should I use, or which FIA should I use when I compare them across each other? And Vineet, I know you do a ton of work on that. And then how do I assess them in my portfolio? You're actually seeing a portfolio construct come about in a lot of advisors' minds. But the underpinning there is advisors' biggest challenge is time. They all want to do more business, work with more clients, and these products are complex, so it can be challenging, and platforms can significantly help in that. So to your question, Tamiko, I get the question a lot, and I view this as not a disruption effort. I don't come from the tech side that's trying to disrupt an industry. This is an enableization effort. If I look at that, and one of the corollaries I frequently use is it's not exact, but it kind of drives the point home, is the airline industry, or you can say the hotel industry. And if you look at things like Orbitz, Travelocity, Hotels.com, Trivago, when you look at Orbitz or Travelocity, it pulls all the information together from multiple airlines into one spot for folks to get to. It did not commoditize the airline industry. Prices are just as high. Now, the coronavirus is probably changing the airlines industry a little bit today, but not counting that, it didn't commoditize the industry. What it did is fill all the seats on the plane. And that is what I'm trying to do and what we're trying to do with the platforms. How do we make this easier, more facilitated, get better information so that advisors can use this product and we can fill the seats on the plane with FIA product, which I know we all want to do. It is true FIAs are much more complex than an airline ticket, but the tools and the platforms are much more robust as well. You can compare, I think we're getting to the point where you compare an annuity, not just to another annuity, compare it to a structured product, compare to other things in a portfolio. There was a couple interesting comments from Vineet and Danette that the market, the industry, that the products are evolving to be more complex. And they can be very good for clients. I've been in this industry a long time for wealth management, and protection is huge, guaranteed income. It can be very good for clients, but to achieve that structure, it requires more complexity. It's just because rates are low, it just has to be there. So how do we help as an industry to drive more volume into these products, which can be very good for clients? You know, I joke sometimes the key to financial services is taking complex issues and explaining them in a simple way. And that's what we're trying to do a little bit, I think, with the platforms. Just as a one statistic point, which I think folks may find interesting, is on the structured product side, about a year ago or so, there was probably 5 to 10% of structured product volume flowing through a multi-issuer platform in the U.S. By May, June of this year, over 50% of structured product volume will flow through a multi-issuer platform. That is a sea change of how things are done. It's advisors using it, right? So it's not disrupting the advisor world, but it is absolutely a significant change on how the advisors get to that. So I think what we're trying to do and where I see is not commoditizing the market, it is enabling the market, giving people tools to help analyze how do I put this in a portfolio and then support my client ongoing and how it's performing in the portfolio, I think is really where we're going to see this go. Our goal is to make sure we can have an advisor, they can double their business without having, or a firm, they can double your business without having to double the number of people to do it because we've taken the administrivia out and added more tools, analysis, and technology to help them drive the relationships with their clients. So rambled on there, Tamika, but sorry.
No, we couldn't agree with you more. Canex is all about transparency. And, I think that's really the direction that things are going. And ultimately, this is a difficult business to commoditize. So couldn't agree with you more. So Charlie, after you give us a little bit about your background, here's your question. What do you think that the industry can do to improve market share for annuities?
Thank you, Tomiko. Great question. Absolutely thrilled to be on the call. I know that lately life for many of us has been a lot like the movie Groundhog Day, and this is a nice way of mixing it up, right? So thank you for having me on the call. Thank you to the audience, and thank you to SRP. So a little bit about myself. So I've been doing the indexed annuity and IUL thing for about 21 years now, basically straight out of college. Already been 21 years. Crazy. Where does time go, right? Over that 21-year period of time, I had the privilege and honor of working for a few of the major indexed annuity and IUL carriers, long-term care carriers as well. So I feel very fortunate in my experience, and that not just multiple product lines, but also multiple distribution channels, as well as multiple functions. I was an executive on the sales side, lastly, with the last corporation up to a year and a half ago, but I also took part in a lot of the product development, product pricing, as well as marketing development. But fast forward ahead to about a year and a half ago, I said, I think I'm going to hand in my corporate badge, and I'm going to go out and I'm going to start a marketing organization. And I'm going to start that marketing organization on the foundation of education, unique education that goes just beyond the product details, education beyond, well, let me run an illustration for you, and then that will determine which product, Mr. Agent or Mrs. Agent, that you sell. Education that goes deeper than that while combining my sales experience along with the technical experience. I created CG Financial Group a year and a half ago, and I'm finding that the business has done quite well as a result of kind of a different mindset when it comes to education around these products. For instance, We at CG Financial Group view the beginning of the sales cycle not as a financial professional sitting down with a consumer or a prospect. I view the beginning of the sales cycle as, Mr. Agent, Mrs. Agent, do you have a logo? Okay, we'll get a logo. Secondly, are you on Facebook, for instance? Do you have a Facebook business page? There are 3 billion people on Facebook. Third, do you have a website, right? So that is the very beginning of the sales cycle, then ultimately about 10 steps in as a client. So that is really, in other words, we build businesses, not spreadsheets, so to speak, and that has been my company here. In addition to that, here soon I'm going to open up my own consulting company because I've been doing some consulting and speaking for marketing organizations, carriers, as well as some agencies as well. Now the question, enough about me, the question, what can we do to increase market share? You know, I think outside of the larger macro developments that have really taken place that'll naturally move consumers our direction, I have kind of 3 different thoughts around that. And what do I mean by the macro developments, by the way? So this morning I logged on to FDIC.com. The average 5-year certificate of deposit, jumbo certificate of deposit, is 61 basis points. A 5-year certificate of deposit. It's a relativity game, right? If we can provide with indexed annuities the potential for 10 times that, or 8 times that, or even 5 times that, it's a relativity game. How much trillions of dollars are in certificates of deposit? The stock market, again, it's a relativity game. We've experienced 3 crises over the last 20 years, and naturally, these are the bigger macro items that are going to move people closer to indexed annuities, as well as the fact that baby boomers that own 60% of our country's wealth, well, they're retiring now, right? The median age of a baby boomer is 65 today, that median age. So those are the larger macro developments that I'm talking about. But the 3 things that I believe that go beyond that can build market share is, number 1, in a world to where the average consumer today is smarter than what the average agent may have been, say, 20 or 30 years ago, because of all this technology, because of Google, because of the ability to get information everywhere. Because of that fact, I think that, number 1, we need to look at education and consumer research a little different, in a little different, a little deeper of a manner. For instance, you know, at the street level here that I'm on every day, consumers as well as many agents for that matter, they don't know how these indexed annuities, many agents, not all of them, they know how the products work, but they don't know exactly what the internal workings are and how it is that these products are able to give some of the upside beyond, you know, a fixed rate annuity, for instance, without the downside of the market. If you're like me, you tend to live inside the jar, and it's hard to read the label on the outside of the jar, and it's just unfathomable, right, that agents and clients don't know what a bull call spread option strategy is, right? Well, we live in this every day, and we understand that, and I think a lot of times it's missed that the agents, you have that ambiguity aversion that if they don't understand exactly how something is able to do what it's able to do, then it's a little more difficult to sell if otherwise they did. Now, I'm not saying option strategies and all that, and insurance license-only agents should understand that, but what I am saying is if they do know that, then some of the more basic questions that might come up from their clients, if they know that beginning part that I just talked about, they're able to more easily answer that. So education that goes a little deeper beneath the surface, while at the same time, Tim, you said it best, being able to explain it in a way that people understand. And that's actually the most important part of the education, right? You know, when I put myself in the shoes of maybe some of the audience, you know, the hedge providers and index providers, are you incorporating that different thought process around education when you have conversations with product manufacturers, for instance? Putting myself in my old position, if somebody would talk to me about this new index or new hedging strategy, and if that investment banker, what have you, were to say, hey, listen, we have actually done consumer research. So yes, here's a product we want to talk with you about. But in addition to that, we've actually done consumer research on, say, 1,000 pre-retirees that show via dial technology, for instance, right, that here are the main concerns that consumers have. And by the way, these consumers also indicate that this strategy, this dividend strategy, this dividend index, just to use an example, that this is the most appealing to them outside of this strategy, that's a whole different conversation, right? Or are you going to those carriers and saying, hey, in addition to that, I can provide you with the package of, yes, that those thoughts around how to educate your distribution so that they can educate their clients. But in addition to that, we can bring distribution as well. So the power of that packaging and the power of the education and consumer research that goes maybe beyond what we've thought about in the past, because educated consumers today, right? Number two, and these last two are very brief. Number two, looking to a younger demographic. These baby boomers, obviously, they're not going to be our target client for the next 20, 30 years. Folks are getting older. What about the millennials? The millennials are going to inherit that money. Plus, look at the millennial that was 20 years old in the year 2000. That millennial started to make some money from 2000 to 2010 up until today. What has he or she seen happen to his or her money over that 10, 20-year period of time by investing that into the stock market? A lot of bad stuff, right? And the millennials are the largest age cohort in the United States of America, around 80 million strong, right? So when you think of these folks, that the oldest millennial today is age 40, he or she is starting to make a lot of money. And maybe it's time that we look at, well, age 40 is kind of the new 60 from a risk profile standpoint, because studies show that millennials are more conservative than their parents and probably more open to these products than what they've been in the past, right? And the third thing is, if there ever was, I guess, any silver lining with any of this that's going on currently, it's the technology. It's not just us needing to embrace technology, but it's also the fact that our distributors are kind of forced to embrace technology, right? And again, I'm talking about thinking differently about technology. Well, Charlie, we have an e-app at our carrier. Well, almost everybody does, right? But what are we doing as distributors or even manufacturers to help those in the downline with branding technology, marketing technology, right? Then prospecting, then virtual meetings, all the way through to e-policy delivery. So technology is the third one. The second one is look to younger generations. And the first one is thinking a little differently about education and consumer research. Tamiko, I hope I didn't go too long, but those are kind of my thoughts there.
No, that was great. Thank you so much. And we'll be having a Zoom cocktail hour with panelists later talking about technology. So, I welcome questions. I haven't seen anything come through, but, in respect of everybody's time, we don't, want to suck up too much of the hour, but I have one question that I think is on everybody's minds, and certainly it's been on my mind since the outset of this from the financial perspective. So, interest rates are critical to the management of guaranteed products, and it does look like we're going to be facing another extended period of incredibly low rates. So how do you see this affecting the outlook for annuities in the coming years? I'm going to actually, so anybody can answer this. I have a feeling that Jeanette may have some comments on this, so I'm going to throw it to her first.
Sure. The interest rate environment is, it's a constant. It's that item that's part of the business and part of these products that is always there. Obviously, when it's a negative influence to the product, it gets a lot more attention. And I think that, what's so interesting to me, and a couple of us in the industry have been visiting a little bit about this, because while the products can sustain certain, and really they're designed to sustain, they're built in a certain environment. And then they're designed with moving levers and parts that you can adjust so they stay relevant even though interest rates change. But when you have such extreme changes that we are seeing, again, sustained back starting in 2019, but obviously I completely agree with you that we're going to have to, that'll be a maintenance for us. That will continue to be the situation for several months, and I hate to speculate just on how long, but certainly enough to where carriers are going to be forced to really look not only at the design of the products and the levers that they can pull within the products, but they're really, in my opinion, going to have to start looking at items that maybe they haven't adjusted in the past so frequently. I think they're going to take a real serious look at internal costs. What are their internal costs? Where are they spending money? What is a good use of their money? I would not be surprised if they start managing their own expectations related to board members about their own internal return and how they evaluate their internal return. Because again, the consumer can only bear so much of this. And frankly, what they really need to take a look at, in my opinion, a lot of these carriers, is there's a lot of competition out there, and they have different business models. So while a carrier that's just in these markets, they have some of their competition that have all kinds of other lines of insurance. And if that particular carrier can subsidize their FIA business from another, that changes the competition. And that really drives other carriers to evaluate how do we really compete in this market, again, at these extreme low interest rates. So not that we'll be privy to that. We're obviously not going to be privy to the, discussions about managing expectations for our internal profit margins. But I wouldn't be surprised at all if those discussions, which I would assume have already started in 2019, you have to because of this environment. And they all know that this environment is not going to change for the better in the very near future. So that to me is I think, a lot of what will be happening behind the scenes, again, which will be interesting in how it impacts and drives the market.
Great, thank you. So actually, we do have a question from the audience, and I want to throw this at Tim. It seems perfectly tailored for him. But what percentage of structured products would you say now flows through multi-issuer platforms?
Sure. And I know I mentioned it in my update, but real briefly. So again, saying what I said, by about a year ago, let's say last June or a year ago from now, there was probably only 5, maximum 10% of structured products that went through a multi-issuer platform. By May or June of this year, not necessarily today, but there's a couple other things kind of going live, there will be 50%, 50, of U.S. structured product volume flowing through a multi-issuer platform. There's only a couple multi-issuer platforms in the U.S., but like I said, that is a fairly significant change in how folks do business. One thing I would add on, just so I have a second, to what even Danette was just saying on how interest rates are going to impact the product as well. I think one of the things that we'll see, it's not just how interest rates, in my opinion, impact FIAs, it's how interest rates are impacting all the products. FIAs can be a net benefit of this because anybody buying, it's been this way for a long time, but it looks like it's going to continue for another long time, of traditional fixed income bonds. Traditional FAs are just going to be very, very low. So the complexity of the FIAs will stay strong, and while it'll impact the products that you'll continue to have some of the dynamic indices that can adjust. And I think that's what we're going to kind of see. That's what it's going to impact it. It's going to increase their needs. So sorry to ramble on, Tamiko.
Oh no, that's great. Thank you so much. So I have a question. It's a good one. So how is this? How are the Secure Act and Reg BI going to impact the annuities market? Does anybody want to address this?
Tomiko, I can touch on that real quick. Charlie here. I can touch on that real quick. Regarding, and Danette, you can probably speak to Reg BI better than I can, but when it comes to the Secure Act, it's prior to the Secure Act, the situation with 401k plans, for instance, is that if the plan provider, the employer, is going to offer a 401k plan, that person has the fiduciary responsibility of doing certain things with a plan, offering various options to the employees that are going to give them their money, and hopefully they do not lose that money, right? So there are rules that this employer has to abide by so that he or she is not subject to a lawsuit should the market drop 50% and those employees lose a good chunk of their money. So they have to follow certain rules, and by following those rules, there is a safe harbor, it's called. Basically, they're able to avoid getting a lawsuit by an employee coming and saying, man, I just lost 50% of my money. Annuities were never a strategy that were a part of that quote-unquote safe harbor. So now, starting, I believe it's next year with the Secure Act in 2021, if I remember right, correct me if I'm wrong here, one of the other folks, but annuities are now a part of that safe harbor, assuming that it's certain annuities and assuming that, again, there are rules around it. So what is that going to do? It's going to bring the 401k world into a world of potential prospects when it comes to these annuities. So that's going to take off, I believe. It's going to help the annuity business take off, but it's also going to add some confusion because of some of the other stuff with the Secure Act, such as the value of your 401k balance. Now the employers or the plan administrators have to show what that would mean in future income versus, say, an annuity. That's going to create a lot of confusion, and that's probably the biggest question that I have around a lot of this. What does that look like? So in short, I think it's positive, the Secure Act. Reg BI, somebody else can speak to.
So if nobody wants to speak on Reg BI, we're actually at 45 minutes right now, and we actually have some great questions rolling in. But I do want to be respectful of everybody's time, and we're all, like I say, we're all sort of out there in the internet and relatively easy to find. So I do want to thank everybody for participating today and thank SRP for organizing this. It's been a lot of fun and very interesting, and we certainly have interesting times ahead for us. I'll hand it back to Amelie from SRP. Thank you.
Thank you, Tamika. Thank you very much as well to all our panelists. As Tamika just said, we have a number of questions that have been asked and we haven't been able to answer because we've run out of time. So for everyone listening, either you can reach out to all the panelists separately, or you can send me some questions and I'll make sure I'll send the relevant person or people the question on your behalf. Thank you everyone for listening. Just a reminder that we have an annuities event later on this year. Sadly, we had to reschedule it, but it will be happening later this year. So please listen for sort of further updates from SRP. So thank you everyone for taking the time to be with us now, and it's goodbye from me. Bye.